What you're about to learn today could save you thousands, and it can help you make some money too. If you're wondering exactly how a rate cut is going to affect your mortgage, your savings, or your overall financial health, stick around. I'll walk you through the relationship between Fed policies and your personal finance. Let's jump in. Before we get started, let's set the stage straight. The Federal Reserve, also known as the Fed, is like the brain behind the operation. It is the brain of America's money supply. When they adjust interest rate, which is called the federal fund rates, they are essentially influencing how much the banks pay when they borrow money. When the Fed raises interest rates, borrowing gets more expensive. It costs more for the bank to access more money. And as a result, because of this, the bank also increases their interest rate, causing the borrower to pay even more in interest on their respective loans. Auto loans, mortgages, credit card, and so on. So as you can imagine, this tends to slow down the economy as people realize that things are getting more expensive. So people start spending less, which as a result lowers inflation. Now, the opposite is also true. When they lower the interest rates, as the Fed did in the last month, they want to encourage borrowing and spending, hoping to boost the economy again. And here's the kicker. This isn't just about Wall Street or the banks. It also hits your personal wallet directly and indirectly. And I'm gonna show you how. Now here's where it gets interesting. A rate cut means that bank can borrow money cheaply. That typically leads to lower interest rate on things like your mortgage, your credit card, your auto loans, and even business loans. But here's the kicker that most people don't realize. 1. Borrowing costs can stimulate economy activity. When you borrow or invest, the economy grows. But this also means that companies and governments can borrow heavily, which could add back to inflation. And that's the first thing we wanted to stay away. Prices of everyday things becoming more and more expensive for you and me. 2. For savers, the rate cuts means you're earning less on your interest. The earnings from your high yield savings account, your certificate of deposits, or your bond yields will drop as interest rates go down. So while borrowing is getting cheaper, your savings may earn you less, squeezing your income from your savings. As a side note, when interest rates are low, it's best to seek alternative investment options that could give you a greater return than you would if you kept your money in the bank account. 3. This creates a direct tug of war between borrowers and savers, and depending on your personal financial situation, whether you're trying to pay off debt or trying to grow your savings, it can feel like a roller coaster sometimes.